All right, so we're diving into high yield investments today, and you're looking for, options in this crazy market. And one thing that seems to have caught your eye is high yield dividend ETFs. That Motley Fool article from January 15th really got you thinking, huh? Especially about that JPMorgan Nasdaq Equity Premium Income ETF, ticker symbol JEPQ.
Yeah, it's definitely one to watch, especially now with, well, you know how interest rates have been climbing these past few years. Dividend stocks haven't really been the star of the show. Bonds were really where it was at.
Right, right.
But things are shifting now that the Fed is cutting rates, and they're saying more cuts are coming. Dividend stocks are starting to, make a comeback.
Interesting.
What's really interesting, though, is that even with these cuts, fixed income investments, those 10-year Treasury bonds, they're still yielding like 4.8%.
So it's almost like you don't really have to choose. You could, I don't know, can you kind of have your cake and eat it too?
Well, that's where a well-structured ETF could come in. Think of it as a way to diversify, right? You can ride that potential upswing of dividend stocks, but you still have that steady income stream. That's where JEPQ gets really, really interesting. It uses this covered call strategy, and that can potentially boost the yield even further, almost to 10%. At least that's what your Motley Fool article said.
Wow, 10%. That definitely gets my attention. But to be honest with you, I'm a little fuzzy on covered calls. Isn't that when you're basically betting against a stock you own?
Not really betting against it. It's more like you're leveraging what you already have to make some extra income. Okay, imagine this. You own 100 shares of Apple, right? Trading at, let's say, around $230 a share. Now, with a covered call, you're basically selling someone the right, but not the obligation, to buy those shares from you at a set price, let's say $250,
Right.
by a certain date. Now, for giving them that option, you get paid a premium.
So I'm getting paid up front just for the possibility of having to sell my shares. And in the Apple example, that premium was like 94 cents a share, right? So $94 for the whole lot.
You got it. Now, if Apple stays below $250, you keep that premium in your shares. But if the price goes above $250, well, the buyer of your option can make you sell at that price. You still make a profit, but you miss out on any gains above that $250 mark. It works really well in those sideways markets, where prices aren't jumping all over the place.
Okay, so if the market suddenly explodes, those covered calls would actually hold me back. Wouldn't I be better off just, managing my own covered calls and trying to time things perfectly?
In theory, sure. But managing all those individual covered calls across tons of stocks, that takes a lot of time and a whole lot of expertise. That's where an ETF like JEPQ really shines. It does all the work for you. It spreads that strategy across a whole basket of stocks, and it does it in a way that's way more tax efficient than you could probably do on your own.
Hold on, more tax efficient? I thought covered calls were already pretty good when it comes to taxes.
They can be, yeah. But JEPQ has this, well, it's kind of a trick to make them even better. They use these things called equity-linked notes, ELNs. Think of them as debt instruments that are tied to how well those covered calls do. And the cool thing is, they can be even better for your taxes.
How much better?
Well, it depends. Your situation, your tax bracket, all that. But the potential savings are big. Big enough that JPMorgan decided to build a whole ETF around it.
Wow, so we're talking high yield, and now we're adding in tax efficiency. JPQ is starting to sound a little too good to be true. What's the catch?
Well, there's always a catch, right? Especially when it comes to investing. But to really understand what could go wrong, we need to dig a little deeper into what JPQ actually owns and how that covered call strategy actually plays out when the market, does its thing.
Okay, so let's get into the nuts and bolts here. What exactly is JEPQ holding?
Well, it basically mirrors the Nasdaq 100 index.
Yeah.
So you're investing in, the biggest tech companies out there, Apple, Microsoft, NVIDIA, Amazon, the big names.
That's a pretty impressive lineup, especially if you're, optimistic about the tech sector's future. But doesn't selling covered calls on those stocks kind of mean missing out on the big growth moments? Tech can be pretty explosive, right?
Yeah, that's a really good point. And it gets to the heart of JEPQ's strategy. You see, it's not really trying to hit a home run with every covered call. It's more about consistency, giving investors those monthly distributions.
Gotcha.
It's more about that dependable income than trying to squeeze every last penny out of, the riskiest covered calls.
So it's almost like a hybrid approach then. You get the growth potential of tech, but with a steady income stream built in, kind of like a supercharged dividend.
Yeah, that's a great way to put it. It's about balance, And remember, JPQ is always adjusting those covered call positions as the market changes. It's not static. It's dynamic. It adapts.
I'm starting to get the appeal here, especially with all the uncertainty in the market right now. But you know that Motley Fool article mentioned JEPQ was trading below its NAV? Is that a bad sign?
Not necessarily. Actually, it could be a good thing. Remember, JPQ is a basket of stocks and other assets, right? When it trades below its NAV, it basically means you're buying those assets at a discount. Like it's a sale at your favorite store.
So I could benefit from the income and if those stocks go up in value. And I'm getting in at a discount.
That's the general idea, yeah. But remember, past performance doesn't guarantee anything in the future. And JPQ, while it has a lot of great things going for it, it's still an investment, and there are risks. It can get a little tricky, especially if you're new to this kind of thing.
Okay, let's talk about those risks then. What could go wrong with JEPQ, especially if the market, takes a turn for the worse?
One thing to keep in mind with any covered call strategy, and that includes JEPQ, is that your gains could be limited if the market suddenly takes off. Remember, those covered calls put a cap on how much you can make if those stocks skyrocket. So if you're all about that maximum growth potential, JEPQ might not be the right fit for your whole portfolio.
So for someone who's, younger and really focused on growth, JEPQ probably shouldn't be the main part of their portfolio.
Exactly. But that doesn't mean it has no place at all.
Hmm.
Diversification is key. Even if you're a growth investor, having a little something that brings in a steady income can be good, especially if those earnings are, tax advantaged.
Makes sense. But what about the opposite? What happens if the market tanks? How does JEPQ handle a downturn?
Well, those premiums we talked about can actually help cushion the fall. JEPQ gets that income no matter what the stock price does. It's like a little bit of built-in insurance.
So those premiums could help offset some of the losses if the stock prices drop.
Exactly.
But wouldn't the NAV of the ETF still go down?
Oh, absolutely. The NAV would reflect whatever happens to those underlying stocks, but those premiums help soften the blow. The drop might not be as bad as if you were just holding those Nasdaq 100 stocks directly.
It sounds like JEPQ is trying to do a lot. Generate income, limit losses, and still capture some of the market's upside. Is there a risk it could end up doing none of those things well?
That's a good question, and it really highlights why understanding JPQ's limitations is important. It's not a magic bullet, and it's not without risk. But for investors who are looking for income, potential tax advantages, and a way to participate in the Nasdaq 100's growth, JEPQ could be a really powerful tool.
So it sounds like JEPQ is like a multi-tool. It's not the best for super aggressive growth, but it can do a lot of things pretty well.
Yeah, that's a great way to put it. And in this market, that kind of versatility, it can be really valuable.
So where do we go from here? I mean, we've talked about the good and the bad, the risks and all that. How does JEPQ fit into, someone's whole portfolio?
Well, that's where the real work begins. It depends on what you're trying to do, your goals, how much risk you're comfortable with, and how long you're planning to invest. If you're really all about that growth, JEPQ might just be a small part of the picture, a way to diversify, bring in some income, while the rest of your portfolio is chasing those big returns.
But if I'm someone who's more interested in income and stability, especially now, then JEPQ might be a bigger part of my portfolio.
Exactly. It could even be a core holding.
Yeah.
You get that steady income, but you're still participating in the market's growth through the Nasdaq 100.
So that Motley Fool article, they were right to highlight JEPQ, but it's not for everyone.
Definitely not. It's a tool, and like any tool, you got to know how to use it. That's why doing your own research is so important. Think about your own situation, and hey, maybe even talk to a financial advisor before you do anything.
Yeah, always good advice. This whole conversation about JEPQ has got me thinking, is there a way to combine, the best of both worlds? What if you had some traditional dividend stocks and then like a smaller chunk of your portfolio in JEPQ?
That's a great question. And it's exactly the kind of thinking this deep dive is meant to inspire. You'd have the growth potential of those individual stocks, the stability of the covered call strategy, and the added diversification of holding both.
Like a custom-built income engine.
Yeah.
Built just for you.
Exactly. The key is research and understanding. Look into those dividend payers, see if they fit your strategy, and then see how adding a bit of JEPQ could make that strategy even better.
This has been really helpful. I appreciate you taking the time to explain all of this.
Happy to help. Remember, the best investment you can make is in your own knowledge. Keep asking those great questions, and you'll build a portfolio that really works for you.
Well, on that note, I think we'll wrap up this deep dive. We hope you found it useful. Happy investing, everyone.
Until next time.